Welcome to the Retiring Real Estate Investor podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to another episode of the Retiring Real Estate Investor. I'm your host, Brandon Bruckman. And we're joined today by Erik Oliver. Erik, how are you?
I'm good. Thanks, Brandon, for having me.
And Erik is at Cost Segregation Authority. So I'm going to give everyone like 3 guesses of what we'll talk about today. First 2 guesses don't count. We're going to go deep on cost seg. And once again, I think this is a topic that we can get a little nerdy on. You think that's right, Erik?
Yes, definitely. Anytime we're talking tax, we can get nerdy on it. So
Perfect. So warm up. Here we go. So maybe start us this way, Erik. How'd you get involved in this field, and sort of maybe give listeners a sense of your background and how you got here in the cost seg space?
No, that's a great question. My kids ask me that all the time. They're like, "Dad, did you grow up wanting to be a cost seg guy?" And I'm like, "No."
Yes, I did.
I didn't know what it was until 7 years ago. So kind of my story is grew up in Salt Lake City, Utah, was going to school, went to college, didn't know what I wanted to do, but I knew I wanted to get out of college as soon as possible. Math always came somewhat easy to me. Was never good at science, never good at English. So I said, okay, I'm going to get a math degree in something. It was either finance or accounting. I found out that I could get done a little quicker if I did accounting. So I ended up getting an accounting degree. Never really used my degree, kind of went into sales and business development after school. Couple jobs took me to the Richmond, Virginia for 12 years, then New York for 5, and then was looking to come back to Salt Lake. I had aging parents, had some kids at the time, so wanted to move back to Salt Lake and came across this job that required some business development skills and some accounting skills. I'm like, well, this is interesting. What is cost segregation? So I actually had to Google it, like a lot of us do, to figure out what the hell it was before I get for it. Was always interested in real estate. I had a few investment properties on my own over the years and wanted to. And so when I found out what cost segregation was, I'm like, oh, this is pretty cool stuff. So interviewed for the job, moved from New York at the time back to Salt Lake, took the job here I guess it's been about 8 years now. And I've loved it. It's been great. I've learned a ton on my own investing journey, just going to different conferences, speaking. I get to speak about cost seg, but then I also get to listen to 2 days about everything else that's out there. And so it's been a great learning experience for me. I love working with clients. It is tax, which sometimes can be tedious and boring. Anytime you hear tax or IRS, no one wants to really talk to you anymore. But it's the good side of tax. We're able to save people significant amounts of money. People who own real estate, it's one of the great benefits of owning real estate is the ability to take this depreciation. And if we can accelerate it by doing cost seg, it just creates huge benefits for people. So that's kind of my journey in a nutshell, how I got here to Cost Seg Authority.
That's awesome. Sounds like my journey as a also accounting degreed college person who didn't use their degree too. Sounds eerily familiar. Figured out very early on that wasn't the path for me, but I'm sure you agree it was tremendously valuable to have that it's the backbone of business. It's business language. Yeah. It's tremendously valuable to have it. It's a great starting point. So maybe let's start this way. So let's level set folks on, and I think sometimes people get confused. What is cost segregation?
Yes. So cost segregation is just accelerated depreciation. So when you buy an asset, whether it's residential or commercial, you get to take depreciation expenses on that asset. So the government says, hey, that asset is slowly deteriorating each year, so we're going to let you write off a piece of that asset. So residential units get depreciated over 27 and a half years. Commercial units get depreciated over 39 years. So let's say you buy an office building. We're just going to make the math real easy. You buy it for $39 million. You take that 39 million, divide it by 39 years, you get $1 million write-off every year. Same thing works for residential units. Let's say you buy a residential rental for $275,000. You're basically going to divide that by 27 and a half years. You get a $10,000 write-off every year. Now, I've oversimplified that a little bit. You don't get to depreciate land, so you always have to back your land out of your purchase price. But the idea is you're getting 1/27th or 1/39th of a deduction every year for the next 27 and a half or 39 years, which is great. Everyone loves deductions. Problem is, I'm probably not going to own my property for 27 and a half or 39 years. I mean, hell, my wife tells me the way I eat, I'm probably not going to be around for 27 and a half or 39 years. I want my deductions. I want my deductions now versus letting the IRS hold on to these for, the course of 39 years. So the way we're able to do that is just as our name entails, is we are segregating the costs of that building. So when you buy, let's use an office building. When you buy an office building, you're not just buying the land and the walls, you're buying a parking lot, you're buying asphalt, you're buying sidewalks, you're buying concrete, you're buying flooring on inside, carpet, you're buying glass partitions, you're buying all kinds of stuff that the IRS says, hey, parking lots don't last 39 years. Carpet doesn't last 39 years. And so they will allow us to depreciate that carpet over 5 years and that parking lot over 15 years. The problem is you just paid $39 million for this apartment building. You don't know what the value of the parking lot is. And so, like I said, we'll come in and say, okay, well, that parking lot of the 39 million you paid for the building, the parking lot was worth 1.2 million. The flooring in your building is worth 600,000. We segregate those costs into different buckets, which allows your tax preparer to now depreciate the carpet over 5 years versus spreading that amount out over 39 years. So at the end of the day, if you were to hold that apartment building for 39 years, whether you do cost seg or what they call straight line or standard depreciation, either way, you're depreciating the same amount. It's just when you do cost seg, you're front loading or taking a lot of those deductions up front, which creates cash flow. There's a number of reasons why you want to do that. There's time value of money. There's inflation is a hot topic right now. Give me a dollar today is worth way more than a dollar 27 and a half or 39 years from now. So that's the idea, is to front load, take all that depreciation, front load it, create a tax savings, take that tax savings and go buy another property and just keep doing it and doing it and doing it versus giving your money to the IRS. So that's kind of the idea. That's kind of basic cost segregation, is just accelerated depreciation on your investment properties.
Gotcha. And why? So maybe talk to the listeners about, why isn't our CPA doing that for us? Like, why isn't our CPA able to sort of break that out? Is it really all about the understanding the valuations, which just isn't in their wheelhouse? Is that where it kind of centers back to why we definitely need someone else like you guys to come in and do that study?
Yeah, that's essentially it. So the IRS does issue an audit guide that tells their agents how to audit these studies. And in that audit guide, it's interesting, there's no governing body for cost seg. So you and I could do cost seg, your CPA could do a cost, anybody can evaluate the components of a building. Now, whether or not that would stand up in an audit is to be determined, but the audit guide says that you have to have constructional development engineering background to be able to put values to the different components. Your CPA or your tax preparer, so the audit guide says two things. You have to have constructional background, you also have tax experience. Your CPA, your tax preparer, checks the one box, obviously, they have the tax experience, but 98% of them have never built a building in their life, and so they don't have that construction knowledge. So it would be very difficult. Imagine going to your CPA saying, hey, I just bought this $39 million building. You give them your closing statement, and then it would be up to them to determine how much concrete's at the building, how much asphalt, not only how much asphalt, but is it 4-inch asphalt or 6-inch asphalt? Because certain jurisdictions, you have to have 6-inch asphalt because you have to have depending on how heavy your fire engine is that has to go there, they have to have certain. So there's all kinds of components like that that a tax preparer would never understand. And so we partner with a lot of tax preparers who say, hey, my clients own buildings. We need cost segregation done. We're not the experts. And so they'll actually outsource that work to a company like ours. But you got it. That's the idea, is they just don't have the construction knowledge. And it's sometimes like if you think about a new build, Brandon, think about if you built a $39 million building, you're going to have construction costs that says, hey, my asphalt was $800,000. But it goes deeper than that. So not only that's something that we could easily pull off and say, okay, $800,000 for asphalt. But what is harder to determine is there's a lot of indirect costs, architectural fees that get allocated throughout the project. That's one area. The second area is it's not just, if we talk about an apartment building, appliances are a 5-year asset. So again, if I build an apartment building and I've got invoices for $200,000 of appliances, that's pretty easy.
Mm-hmm.
But not only do we get to segregate those appliances, we also get to segregate the electrical work that go to those appliances.
Oh.
So now you've got an invoice from your electrician that says, hey, to put electrical work into your apartment building was $1.2 million. Some of that was for the plugs around the bottom of the baseboards, but some of that was specific to your washer and dryer, specific to your garbage disposal, specific to your ceiling fans. That electrical work, we can actually allocate that to those 5-year assets, and we can depreciate that cost over 5 years versus 27 and a half. So again, you kind of have to understand how buildings are built and kind of what's behind the walls to be able to truly maximize the tax savings for the investor. And that's why most CPAs won't do it. There are some CPAs who will kind of cherry pick and say, hey, you've got an invoice here for $800,000 worth of asphalt. Mm-hmm. They'll take that, depreciate it over 15 years. But oftentimes you're leaving a lot on the table because they're missing things like the indirect cost, the allocation of electrical, plumbing, et cetera. So kind of why CPAs don't do it.
Gotcha. No, it makes total sense. So now I'm thinking about what's a good fit for a building or a real estate investment that I buy. Yeah, I should do a cost study on that one. Or you look at certain assets and you go, nah, maybe not in terms of the value that you receive out of that. How do you sort of look at that if a new client is coming to you with an asset? Can you quickly determine if that one's a good candidate for a cost seg study and this one isn't?
Yeah, we can. So most reputable cost seg companies, they'll do a free benefit analysis where you go to them and say, hey, I bought this single family rental. I bought it for $400,000. Here's the address. Does it make sense? And they can run some preliminary numbers and give you an idea of what your estimated tax savings would look like. Ideally, anything with what they call depreciable basis over about $250,000. So your depreciable basis is your purchase price minus your land value. Mm-hmm. So if your purchase price minus land value, if that number is over $250,000, it's probably worth investigating to see if cost segregation makes sense. We usually segregate somewhere around 30% of a building's cost into short asset life. So if you've got a $250,000 asset, we're going to segregate somewhere around $75,000 worth of short-term assets. And then you can take those short-term assets. There's something called bonus that allows you to accelerate it even faster. Mm-hmm. And so you can take a good portion of that $75,000 all in the first year. And so a $75,000 write-off, if you're in a 30% tax bracket, that's over $20,000 in tax savings. Mm-hmm. So, typically a study like that might cost you $2,800 to $3,000 on a single family rental. So to pay $2,800 and save $20,000 in taxes, that's usually well worth it. Mm-hmm. Now, if you're buying a $60,000 home out in the Midwest somewhere, and land is worth 20%, so you've got only $50,000 of depreciable basis, cost segregation probably doesn't make sense because, yeah, you will save a couple $1,000s in taxes, but you got to pay a couple $1,000s to get the study done. So that's why I always will tell clients or advise clients, anything with a depreciable basis over 250 is worth looking at. Mm-hmm. The other thing you want to consider, Brandon, is just because we can create a $75,000 deduction doesn't mean that's going to save you any tax money. So, for example, let's say I'm I'm a investor. I've got a bunch of renovations I did this year on one of my assets. I have $100,000 in renovations.
Mm.
Let's say that my income from my rental properties is 75,000. I already have $100,000 of deduction potentially to offset that 75,000 of income. So why pay somebody to do a cost seg study and create another 75? What's going to happen is that additional 75 is just going to carry forward into future years.
Mm.
And you want to use, you don't ever lose it, but you also don't want to pay for something that you're not going to receive benefit from for a year or two. And so that's why we run the analysis, is so that our clients can then share that with their tax preparer and say, okay, tax preparer, is this the right time to do the cost seg?
Yeah.
Well, actually, you had a low income year and you expected to have higher income next year. Why don't we save this cost seg study and do it next year? Because we're offsetting income that's taxed at a higher rate. So you want to use your deductions and your cost seg deductions to offset or manage your tax brackets. And so that's the nice thing about cost segregation, is it's super flexible, that you don't have to do cost segregation in the year you buy the asset. If you had low income that year, just kind of keep it in your pocket, pay your little bit of taxes on that low income. And next year, when you have high income, do your cost seg study next year, create a larger tax savings, and go from there. And so cost segregation is very flexible. Just because, again, we can create the deduction doesn't mean it's the right time for you to utilize it. And that's why we always want to get your tax preparer involved, because they've got a better understanding of your whole picture. Maybe you made a huge charitable contribution this year and you've got a huge write-off. Well, then don't pay to have cost seg studies done. But maybe you had a high income, or maybe you sold the property, you've got $1 million in capital gains and you've got nothing to offset it. Well, do a cost seg study that year so you can create some deductions. So you want to use it to manage your tax brackets.
This is interesting. So I bought that $39 million building, or office building. Let's carry that example forward.
Okay.
I bought it this year, but I don't need the deductions. I can do that cost seg next year. Could I do it? Is there any time limit? Could I do it 5 years from now if I really felt like it?
You could do it 5 years from now, 10 years from now.
Wow.
You probably wouldn't do it 30 years from now, because 30 years from now, you've already taken 30 years worth of depreciation out of the 39. So there's not a lot to bring forward. But yeah, you can just take your standard deduction for the first 2 or 3 years, that 1/39th of a deduction. You have to take that by law. You take that 1/39th of deduction. And then in year 4, when you have high income, that's when you do the cost seg study. All the missed depreciation that you could have got from the first 4 years, you get to bring that all forward and drop it on your current tax return without having to amend. There's actually a form that the IRS, you have to fill out a form from the IRS. It's a 3115, but it's called a change of accounting method. And it's interesting, on that form, you're actually telling the IRS, hey, I screwed up for the last 4 years. I was depreciating my carpet and my parking lot over 39 years. I should have been depreciating my carpet over 5 and my parking lot over 15. Because I made that mistake, let me make the correction this year. And all that missed depreciation, you get to bring it and drop it on the current tax return. So there are CPAs out there that'll tell you, if you're not doing cost seg, you're actually doing it wrong.
Yeah.
Because you're depreciating your carpet over 39 years and it should be depreciated over 5 according to the tax code. Now, is the IRS going to come after you, Brandon, and say, hey, we owe you a bunch of money, you should have been doing it this way? No, they're not going to do that. That's just more money in their coffers. But technically, you are doing it wrong. We're actually checking a box on that 3115 tax form that says we're going from an impermissible method of depreciation to a permissible method, saying, again, we screwed up, we want to fix it, and let's bring that money forward and drop it on our current return without having to amend, which is great.
Oh, that's interesting. So I had heard that, imagine if you don't take any depreciation on your building, the IRS doesn't care. They expect you to do it anyways. So when they do their math, and correct me if I'm wrong on this, but when they do their math, they assume that you have been taking depreciation, say at least on a straight line basis, over a certain period of time. They're expecting you to do that, and it's incumbent upon you to take it. That's correct, right?
Yeah, they expect you to do it. And when you sell it, you have to pay some of it back. And so you might as well take it, because if you don't take it, you still have to pay it back, assuming you did take it, because the IRS wants you to take it. You have to take it by law. So yes, you're correct.
And it's the point that a lot of our clients who are going through a 1031 exchange forget constantly when they try to calculate their tax liability They go, oh, my cap gains tax rate is X. I'm like, oh, that's cool. What's the depreciation recapture? And I get a lot of quizzical looks. They don't think about that component. It can be sizable to add up to that bill, can it, if you're not doing an exchange?
Yeah, it can. So that's a question we get asked quite often, Brandon, is hey, how does this recapture work? Because recapture is calculated based on how much depreciation you've taken. So I'm sitting here saying, hey, don't take a little bit, front load it and take a whole bunch in those early years. And people will say, well, Erik, what if I sell my building? Don't I just have to pay it all back? And the answer to that question is no, you pay some of it back, but you pay it back at a lower rate on a lesser amount and save the spread.
Yep.
And I'll back into that example because I think it's a little easier to illustrate. But let's say you buy a building for $1 million and 5 years later you sell it for $2 million. When you go settle up with the IRS, you're telling them that everything is doubled in value. I bought all this stuff in this office for $1 million. 5 years later, everything in this office was worth $2 million when I sold it. And they're going to charge you tax on that. They're going to say you had $1 million in gain. Well, my walls have doubled in value and the land is probably doubled in value, but this dirty, nasty carpet that's 5 years old and stained is not worth double what I paid for it. And so why are you telling the IRS that your carpet is worth double and they're taxing you on that? So I've mentioned a couple of times, carpet is a 5-year asset. So what is the book value of your carpet after owning it for 5 years? It's zero. It has zero book value. So you should be selling your carpet for zero and say, hey, I'm selling the land and the walls for more money. And what happens is it pushes that gain into the capital gains bucket, which means you're paying 20% on it. So you take your deduction today, doing your cost seg study at 35%, let's say, pay it back at a 20% capital gain and save the spread. And you can't do that unless you've done cost segregation because you don't know what the value, you've never broken out the value of your dirty stained carpet. So you can't make that calculation. I'm horrible with tax forms. I think it's called a 4797, if I'm not mistaken, but it's the allocation of sales price upon sale. So when you sell an asset, you have to tell the IRS, the land is worth this, the building is worth this, the stuff inside the building is worth this. And if you tell them the stuff inside the building is worth zero, the carpet, the countertops, etc., then you pay less tax on that because it shifts it over into the capital gains bucket. So in summary, take your deduction at a high rate, pay back a portion of it at a lower rate at a future date, and save that spread.
Oh, I love it. So even if you decide not to do an exchange, there's still economic value for you there.
Oh yeah, even if you don't do now, if you do an exchange, you just kick that bucket down the road, exchange, die, and then our estate gets a step up in basis, and no one pays tax, which is a great strategy. A lot of people will do that. But if you're not doing an exchange, and this is why, Brandon, we've got commercial real estate brokers that we work with who will call us and say, hey, my client wants me to sell their building. They bought it 5 years ago for $1 million. They're selling it today for $2 million. Can you do cost segregation right before we sell this asset? And the only reason they're doing that is so that when they allocate the sales price, they know what the carpet was worth when they bought it, and they can pull that out of the depreciation recapture. And so again, you don't have to do an exchange. You can, there's still basically rate arbitrage, taking your deduction at a high rate, paying it at a lower rate, and saving the spread. And that rate arbitrage, I've kind of done some quick math on any asset over 500,000. So if you buy an asset over 500,000, that rate arbitrage is in your favor, even if you only hold the property for one taxable year. So even if you should even be doing cost seg, even if you only hold it for 1 year and sell it, because that rate arbitrage is going to be more than what it costs to get the cost seg study done, and you're going to save significant tax dollars.
I like it. Let's talk about some of the implications of current tax law on cost seg. It's been really impactful, right? Maybe start us with bonus and accelerated depreciation that is winding down. It seems at this point has to by law, right? We need a new law to get that extended, right? What has been the impact of the bonus and accelerated depreciation? Has probably been absolutely amazing.
Yeah. So bonus depreciation basically has put cost segregation on steroids. So we were doing cost segregation long before bonus. You still want to take something that gets depreciated over 39 years, and take as much of that and depreciate it over 5 years.
Mhm.
But bonus depreciation is a tool that the government uses to stimulate the economy. So if the economy is not doing well, they'll increase the bonus percentage. If the economy is doing well, they'll decrease it. And the idea is to get people to go out and buy stuff. So they're going to give you an extra incentive to go out and buy stuff. So the bonus law back in 2017 was you had to have an asset that had a useful life of 20 years or less. So a lot of people think it doesn't apply to real estate because real estate's 27 and a half and 39 years. So I've talked to CPAs and they're like, hey, bonus doesn't apply to real estate. Well, just wait a second. If we segregate it into 5, 7, and 15-year buckets, all of a sudden it does apply.
Oh, wow.
But where you had to have an asset 20 years or less, and the asset had to be brand new. You couldn't go out and buy a used bulldozer. You had to go buy a new bulldozer. And then at the time in 2017, you got a 50% bonus. So let's just do some quick math. If I buy $1 million brand new bulldozer, I would get to write off 50% of that, or 500,000 of that in year one. And then the other 500,000 would get spread out over the useful life. And so again, you can see how that would, at the end of the year, you got a tax liability, you need a bulldozer anyways, you go out and buy a new one, stimulates the economy, it's good for everybody. Well, at the end of 2017, Donald Trump was our president, Donald Trump owns real estate, and Donald Trump revised the tax code. And when he revised the tax code, he made it very favorable to real estate investors. Two things changed. It was with the Tax Cuts and Jobs Act, they changed that bonus depreciation was no longer 50%, it was now 100%. Mm-hmm. So any assets bought between September 27th of 2017 and 12/31 of 2022 were eligible for 100% bonus. Mm-hmm. So now if I go buy that same $1 million bulldozer, I'm getting 100% of that, or $1 million write-off in the first year. So that's huge. That's great. That was the first big change. The second change, which I think was more impactful and probably less people understood how it was going to work, but they added 5 words to the tax code that made all the difference in the world. Remember, prior to 2017, it had to be brand new equipment. Couldn't be a used bulldozer, it had to be a brand new bulldozer. They added the words new to you, the taxpayer, which I think is actually 6 words, new to you, the taxpayer. Depending on if taxpayer is one word or not. I told you I wasn't good at English. So 5 or 6 words. They added 5 or 6 words to the tax code. And now if I go buy a used bulldozer, that's new to me, the taxpayer. Yeah. So I'm eligible for bonus. So let's stop talking about bulldozers because I don't know how many listeners buy bulldozers, but let's talk about how this relates to real estate. Now, under the new tax law, any real estate that I buy, any components of that real estate that have a useful life of 20 years or less are eligible for 100% bonus. And I don't have to build it. It doesn't have to be brand new cabinets in my apartment building. If I buy an apartment building that was built in 1980, and there's cabinets in there, those cabinets are eligible for bonus depreciation. So this was great for our industry because now, Brandon, in order for you to take advantage of bonus, when you buy your apartment building, you have to call us and say, hey, I've got this 27.5-year asset that's not eligible for bonus. I want to take bonus. So I need to know what my 5, 7, and 15-year assets are, because remember, it has to be an asset 20 years or less. So we come in, we do our study, and we say, hey, Brandon, you've got $180,000 worth of 5-year assets. Well, now, because those assets were bought between the end of 17 and the beginning of 2022, you get 100%, or you get to take the full $180,000 deduction on those assets. So you had mentioned that bonus is phasing out, which it is, in fact, phasing out. So anything bought between 9/27 of 17 and 12/31 of 2022 was eligible for 100%. Anything bought in 23 was eligible for 80%. Anything bought in 24 is eligible for 60% currently. And I say currently because Congress did put forth a bill at the beginning of this year to extend the 100% bonus through 2026.
Oh, wow.
It had bipartisan support. It made it through the House almost unanimously, got to the Senate, and there was a few senators, in my opinion, who said, wait a minute, this is a presidential election year. If we pass this year, it's going to look good for Biden, and we don't want to do that. And so they basically killed the bill. What I think is going to happen, what a lot of us think is going to happen, is after this presidential election here in November, Congress will get back together. They're going to put together a comprehensive tax bill that they're going to push forth prior to us filing our taxes next year. So I would say next January or February, I think they will extend the 100% bonus, regardless of who wins this presidential election. Everyone in Congress, they all own real estate, whether they're Republican or Democrat, whether they admit it or not. They all own real estate. They all want bonus depreciation to be in place. It's kind of nice the way they put this bill together, because the bonus depreciation expires at the same time as the child tax credits. So the Republicans want the bonus depreciation. The Democrats want the child tax credit. So they say, hey, we'll give you your child tax credit. You give us our bonus. They're going to vote on it. I think it'll pass, which means anything that was purchased this year in 2024, they'll retro date it back to the beginning of 24, will be eligible for 100% bonus. So right now the tax law says 60. It actually goes down 20% every year. So it was 80% in 2023, 60% in 2024, 40% next year. It phases out 20% until 2027 when it's down to zero. That's the current law. But if Congress can get their act together and pass this by next tax season, I suspect that we'll get 100% extended at least through 2026, which would be great for investors, because now, like I said, it really just puts cost segregation on steroids and creates these huge deductions that make it so you're not having to pay a lot of taxes.
That's fascinating. And we deal with this. We're involved in a lot of the 1031 exchange side. So we have our eyes in the same place that you do. Opportunity zones as well.
Yeah.
So looking for new legislation there too. And it also seems stalled. So we always sort of have an eye to Washington for some of these issues. On that legislative front, continuing down that path, CARES Act. How did the CARES Act impact what you're doing from a segregation standpoint?
Not so much from a segregation standpoint. There were a couple things in the CARES Act that were impactful for real estate investors. Two things specifically. One is a program called 45L, which is for the construction of energy efficient residential units. So if you are a developer or an investor and you're building residential units, these could be single family homes, duplexes, apartment buildings, student housing, senior housing, anywhere where somebody lives, you may be eligible for anywhere from $500 credit to a $5,000 credit per unit. So remember, the government uses the tax code to incentivize us to do what they want us to do. So they're going to incentivize us. They want us to build homes that are energy efficient, that use less energy. And so if you are a developer and you are building those types of homes, you may be eligible for these credits. And these credits are substantial. Like I said, they could be as much as $5,000 per unit. Oh, wow. And this is a deduction. Remember, cost seg is a deduction. Depreciation is a deduction. These are credits. These come right off the top of your tax bill. So for any of you who are listening, who are building new residential units, definitely look into the 45L energy credit program. That's on the residential side. Part of the CARES Act on the commercial side was a program called 179D. 179D had been around for a number of years. The CARES Act made it somewhat permanent. I think it's permanent through 2032, if I'm not mistaken, but made it somewhat permanent. And the 179D is a similar program, but it's for the construction of commercial units. So if you're building retail space, office space, medical space, and you're building it to certain specifications that meet the energy efficiency that has been put forth by the IRS, you're eligible on the commercial side up to $5 per square foot of a deduction. So it's anywhere from $1.80 up to $5, depending on when you put the building into service and when you built the building. But that is a deduction that is on top of your cost seg. And so people who are building new office buildings, we go in and we do a big cost seg study. We give them all this deduction. Then we do a 179D study to determine whether or not the building is energy efficient. If it is, they could get up to $5 per square foot and get another deduction on top of the cost seg. So those two programs with the CARES Act have become more and more popular. They're still probably two of the most underutilized tax credits and deduction in the real estate world. But if you've got developer friends, or if you yourself are developing and building ground up, it does work on renovation projects.
Mm.
It's a little harder to qualify because you basically have to take your building down to the studs. You got to put in new insulation, new walls, new windows, new HVAC. But for anything ground up, it's fairly, I don't want to say fairly easy to qualify, because there are a number of hoops you have to jump through. But a lot of the building codes and the materials that are required to be used by different municipalities across the country make it so that sometimes, just if you're following code, you may qualify for this credit or this deduction. So definitely worth looking into.
You're not kidding about the underutilization of those deductions and credits. First time I've heard about them was having this conversation with you. With that said, though, I'm also not a developer. So maybe some of our developer friends are on this and they're working that into their numbers already. And Ray have a good understanding of that. Erik, this has been awesome. What's the best way for people to sort of work with you? Should they start with you and then to their CPA, or the other way around, or loop you guys all in together? Like, hey, let's all get on a call and talk about how to do this study. What's the best way for them to sort of operationalize this?
Yeah, that's a great question. And it can be done a number of ways. Typically, the way I've seen it done is investors will call us and say, hey, I bought a building. I think that it's probably a good candidate for cost seg. Can you run some numbers? We'll run some numbers. We'll get you an estimate. Share that estimate with your CPA and say, hey, CPA tax preparer, here's based on my portfolio of real estate, here's the deductions these guys can get me. Now let's talk about how to utilize those and maximize the savings. And so some CPAs, if they're real estate focused and real estate savvy, they can go through that conversation pretty easily. Others, we're happy to jump on the call. We want to partner with your CPA and get them involved early in the process, because we don't know your whole tax liability, Brandon. We know that you bought a building, and we know we can save you some money on that building, or save some money by utilizing that building, but we don't know if this is the right year. We don't know how much income you had. We don't know what other deductions you may have. We don't know all those factors. And so getting the CPA involved early is definitely key. We don't ever want to engage somebody. And I hear it happen all too often where somebody calls a cost seg company. The cost seg provider just wants to sell a study. So they're like, hey, Brandon, we're going to save $100,000 on your taxes. Sign here. You sign it. We do the study. And then we go back to your CPA and says, your CPA is like, well, Brandon, you had this huge carry forward loss from last year. You can't even utilize that $100,000 deduction for at least another 2 years. And so that's why it's important to get with somebody who understands it, who's not just trying to sell you a study. We want to be consultative. And I tell people daily, hey, here's what we can do for you, but I don't think this is the right time for you to do that based on what you're telling me. You're telling me that your income is down this year. You're telling me you sold a property. You're going to have higher income next year. Let's wait and let's do this next year. I'll put a note in here to call you in 6 months and we'll pick the conversation back up. So to answer your question, definitely work with a reputable cost seg company who's going to provide you an analysis, which again, most of them will, and then get your CPA involved early to make sure that you can actually utilize those deductions.
Oh, it's perfect. It's perfect. Yeah, we say the same thing from our desk. I'm not your CPA, but man, we need him. We need him to have this conversation. It's too important. Erik, thank you so much for this. I learned a ton. I'm sure our listeners did too. What's the best place for people to find you? How do they track you down?
Yeah, so our website is probably the best. It's just www.costsegauthority.com. My contact information is on there, email, phone number. Please use this as a resource, you guys. We're kind of a unique accounting firm where we don't bill by the hour. We actually don't even do tax returns at our firm. We just do these cost seg studies. So please use this as a resource. Don't call me and ask me about child tax credits and earned business income, because I don't know anything about that stuff. I'm going to refer you back to your CPA. But if you have questions on depreciation or some of these energy credits, we're definitely happy to ask or happy to help. I think the weirdest question I've been asked is how to depreciate mule deer at a breeding facility in Wisconsin, actually, where you're from. So I didn't know the answer to it, but we've got folks here in our office who know the answer, and we're able to get the answer for them. So please, again, don't use this or don't hesitate to use this as a resource. We're happy to help. Feel free to give us a call or reach out anytime.
Awesome. Erik, thank you again so much. This has been awesome.
Yeah, no problem. Thanks for having me. It's been great. Thanks, man.
And thank you all for listening. Until next time, take care.